Hello everybody. My name is Radovan Vojtko. I'm CEO and Head of Research at Quantpedia. Thank you very much for watching this. And I have guests here. I have here Michael Robbins, Professor Michael Robbins from Columbia University. I have Professor Campbell Harvey from Duke University. And I have Assistant Professor Alessandro Melone from the Ohio University. So thank you very much. Thank you very much for joining. And the topic for today's discussion will be the paper called The Unintended Consequences of Rebalancing. And this paper is the winner of our Quantpedia Awards 2025 competition. So thank you very much once again. I will start with the questions. I will try to get directly to the point. So my first question is very easy. How you got into the quant world? So, I mean, why this world? Why you decided that you want to be the quant and not something different? So that's my first question.
I was a master's student, and I was in an internship after my first year, and I was assigned a task that seemed like an impossible task, to develop a quantitative forecasting framework for real US GDP for the largest copper miner in the world. And I had limited resources. It was me. And I kind of discovered that with just me, some data, and some quantitative techniques, that I could produce forecasts that were as good or better than more expensive survey-based forecasts. And that really got me energized about quantitative methods. And eventually I went on to the University of Chicago to do a PhD in finance and economics. And obviously at Chicago, that's heavily quantitatively focused. When you have people like Lars Hansen on your committee, it's going to be quant. So I saw the power of these methods, but I also saw some of the downsides, where we've got people that use the word quant, but really don't understand how to do research in a way that whatever the result they get in a back test will repeat in the future out of sample. So I'm also part of my research focus is to call out quantitative practices that are poor, like data mining, backtest overfitting, and other things that essentially it looks good and maybe a publication, but it does not work out of sample. And as finance researchers, we're in the practice of impacting management in a positive way. And it's not about just publishing a paper. It's about publishing something that can be useful for the end user. And our paper on rebalancing is a good example of that.
Yeah, thank you. Thank you. And now I have a question to you, Alessandro. You are a little younger. So, I mean, what was your journey to quant world?
I have a background. My undergraduate is in maritime economics. And I wrote my thesis on shipping finance, specifically on private equity in the shipping sector. I did a small internship in Geneva, and talking to people. I wanted to do shipping finance for a living. And talking to people, they all told me, if you want to do this in your life, you need to have a more solid background in quantitative finance. So I started looking for a master in quantitative finance, which in the end I did, and I studied my hometown in Rome at the University of Tor Vergata. I started there. I did a semester abroad at HEC Lausanne in Switzerland. And since then, I was always in love with quantitative finance and empirical asset pricing. I was lucky enough during my master. I had a great asset pricing teacher, Cesare Robotti, that at that time it was at Imperial College. And it was just about passion for asset pricing that really pushed me to go beyond and study PhD. And then I started a PhD in Vienna. I spent some time in Bocconi. I spent some time at Northwestern University, Kellogg, and now I'm at Ohio State.
Okay, cool. Thank you. And now we would like to get to your paper. I mean, me and my co-host Michael. So we would like to give you, both of you guys, time and space to tell about your paper and what was the idea behind the paper, how you got to the idea to study the rebalancing and what are the results and what we can take away from it as asset allocators and also as speculators. So because, some of us are traders. I'm a trader. So for me, the more interesting part is, not how to avoid the mistakes, but how to make money out of the mistakes of the others. So, but now I will leave the space to you.
The idea of the paper is really straightforward. Rebalancing is something that portfolios have to do. And it is a fundamental concept in finance. And it's really all about diversification. So you figure out what the optimal weights are for various different asset classes. And then because the risk and return characteristics vary across the different asset classes, from time to time, you need to rebalance towards your target weights. For example, we'll talk a lot about like a 60-40 equity fixed income capitalization weighted portfolio. The expected return on equity is much higher than fixed income. And if you just start with the 60-40 and let it run, eventually that equity is going to be 90% of the portfolio, and the portfolio will be severely undiversified. So we have to do this. It's also the case that large institutional investors have pretty strict mandates in terms of the mixes, let's say equity and fixed income. And this is a substantial portion of the market. So if you look at pensions, target date funds, endowments, sovereign wealth funds, you put all that together, and within the US, we're talking $20 trillion. So this is quite large, and we'll refer to this as the rebalancing complex. So as in any academic paper, we've got some questions that we would like to answer. So number one is, given the size, $20 trillion, does this rebalancing have impact on the prices in the market? Again, we're focusing on the US, the largest and the most efficient market in the world. And you might be skeptical that we would actually find some sort of impact from this rebalancing. Number two, the rebalancing rules are public. So you know when these institutional investors are going to rebalance. And given these trades are large, and given that there's potential price impact, is there a risk of front running? And the answer here to both these questions, we will argue, is yes. Let's actually take a look at what the target and actual allocations look like through time. And this is, again, public plans data, and it's remarkably close to a 60-40 and stable. So it's a little higher, so maybe 65-35. But what I want you to look at is the actual equity, which is in the solid line, and on top, the blue, and then the target, which is the dashed line. Again, that target is very stable. There are some deviations, but the deviations are small. So look at the global financial crisis, 2008, 2009. Those are small deviations. And it suggests that these funds are actively rebalancing to get as close as possible to the target. So this is like evidence that the rebalancing is really a big deal. In one slide, we find that when stocks are overweight, meaning equity has gone up in value, you need to sell stocks, buy bonds, and this leads to a 17 basis point decrease in equity returns and a 3 basis point increase in bond returns. Now, these rebalancing trades are not what we call information trades. The funds that are selling equity, they're not selling equity because they think that the market is going to go down. They've got perhaps special information about that. No, they are just selling equity to get back to a target, and that's it. And we do find that these pressures that we document are temporary and largely go away within 2 weeks. We also have like a battery of kind of other control variables that we look at to try to see if we can get rid of the effect that we document. And we're not successful in actually doing that. So this is a highly robust finding. Why is this important? So it's one thing to ask some questions, but they need to be important questions. Our evidence is novel. There's plenty of papers that look at the effect on individual equities of, let's say, rebalancing the S&P 500. That's not what we're doing. We're looking at the market as a whole. And this is one key contribution of our paper. And then we also document that given these front-running possibilities, this translates into a significant, both statistically and economically significant cost for the rebalancers, and economically and statistically significant gain for those that are on the other side. When we started this research and initially saw the findings, we were skeptical, and we decided before releasing the paper to try to get some external validation of our findings. So we put together a roundtable of 16 senior people at large pensions. So I'm talking CIO level. And around the table were about $2 trillion under management. We asked them about the rebalancing, and all of them had a systematic rule-based rebalancing, and it was one of 2 types, either calendar or threshold. And we'll go through the details of this later because we study both of them. We said that our preliminary findings suggested that there was price impact from the rebalancing, and they said, we know about that, and we know it's a problem. So initially, getting that information that validated our statistical findings. We also suggested that given the profitability of the sort of trading strategy that we detailed, that it was likely that these funds were being front-run. And the idea here is that, let's say, equity's gone down, they need to buy equity to rebalance. This will have a positive impact on the equity return. Given that everybody knows that the fund is going to rebalance, they get ahead of the trade. And this is the front running. So we asked them about this and said, yeah, we know it's a problem. We know we're being front run. And then we asked them, well, why don't you change your rebalancing strategy? And they argued that it's actually easier said than done, that it's actually complex to do a new rebalancing strategy, to get it through the investment committee. And it was somewhat frustrating for these CIOs that they, given their current rules, were just being front run, and there was little they could do about it. One of the pensions then kind of interrupted and said, yes, this is exactly the issue. It's really difficult bureaucratically to get a change in a fundamental investment policy like rebalancing. So instead, we send the signal to our alpha desk. And we were like really dumbstruck by this. We asked, does this mean that you are front running your own rebalancing and the rebalancing of your peers? And they said, yes. So to be clear here, the front runners are not just hedge funds, but some institutional investors that understand that this effect is substantial, and they want to mitigate the negative impact for their pensioners, and they're front running. They've joined the party. So I'll turn it over to Ale now to go through some of the results quickly.
Thank you, Cam. To test the implications of rebalancing, first one has to construct some rebalancing signals. Key challenge is to capture the different frequencies at which investors do rebalancing. Indeed, we know that some funds do rebalance at end of the month or the end of the quarter. Some funds do rebalance daily. Some other funds have very public information about their investment policies, like Norges. We know they have this 70-30 portfolio, and they say equity cannot deviate more than 2%. So we did research, and we found that overwhelmingly, two are the most used rebalancing routes: threshold and calendar. Now, threshold rebalancing is the Norges approach. You rebalance your portfolio when the weights are more than some delta percentage point distant from their target, with the idea of minimizing transaction costs over time. The calendar rebalancing is we rebalance towards the end of the month or the end of the quarter. Think of the average US pension plan with negative cash flows, right? With more outflows than inflows. They have to pay their members the benefit. They will have to sell some asset at the end of the month. What do they sell? The overweight asset. That's rebalancing. Now, what's important for us is that both these schemes, these rebalancing schemes, induce predictability. And we exploit this predictability to construct rebalancing signals. Specifically, we simulate a balanced 60-40 equity bond portfolio, and we extract both threshold and calendar signals by measuring the distance of the equity allocation from its target. We do this every day. And the signals are the function of past equity and bond market returns. So consider the situation in which market goes up 10%, bond is flat today, both signals would increase by 66 over 106, the total value of our portfolio. This is about 2.26% increase. Now, we have two key parameters that we need to calibrate to test these rebalancing signals. The first one is the rebalancing range delta, which is associated with the thresholds. This can be 1%, can be 2%, like Norges, can be 3%. Second is the range of days when we expect that the calendar is more relevant. Our empirical calibration is simple. We regress future returns on today's signals, and we test whether there is predictability. On the left panel, we have the results for thresholds. We report the statistics from these predictive regressions with a delta going from 0 to 4. And you can see at least two things from this plot. The first one, between 0 and 2.5, the t-stat is high, is above 2.6. So high predictability, strong predictability. And second, notice that there is kind of a peak of this predictability around 2%. And this is not by chance. If you think that large funds like Norges or Vanguard, they do have explicitly this number. On the right panel, kind of a similar story for calendar. We see that funds do not rebalance the very last day of the month, and pensions told us at the roundtable they kind of spread the trade over the last week or so. And this is indeed what we find in the data. Given this evidence and throughout the paper, when we talk about threshold and calendar signals, we mean the average threshold signal between 0 and 2.5. And the calendar signal is the signal capturing the last week of the month effect. But let's have a look at some regression evidence. Here we predict returns using our signals. In column 1 and 2, we predict what we call cross-asset return, the difference between equity and bond. We use S&P 500 and 10-year Treasury note future returns. As controls, we always include momentum and past returns. Why? Because remember that threshold and calendar are function of past returns. So we want to be sure that the facts that we are documenting are not a byproduct of other well-known price anomalies. In the first column, you can see that both the threshold and the calendar signal are statistically and economically significant. The t-stat is well above 3, and we find that one standard deviation increase in the signal implies about 20 basis points decrease the next day. In the second column, we also include a bunch of controls. As Ken mentioned, we do our best to eliminate these effects. So we control for measures of sentiment, of volatility, of macroeconomic conditions, and we find that neither the statistical nor the economic significance of these predictive coefficients has really changed. One may ask, but is the predictability coming from equity or coming from bonds? And the answer is from both. Indeed, in column 3 and 5, we report results of predictive regressions of equity and bonds, and we find that the t-stat are high. Importantly, look at the sign of the predictive coefficients. Is negative for equity, is positive for bond. This means that when rebalancing signals are high and stocks are overweight, on average, funds sell stocks and buy bonds. In column 4 and 6, we include the controls again, and we find that results are largely the same. This claim that rebalancing pressures are temporary is kind of evident from this plot, where we report the predictive coefficients for these predictive regressions going from t+1, t+2 until t+15. Here we have daily returns. And you can see that for both the threshold rebalancing, the left panel, and the calendar rebalancing, the right panel, the predictability largely dissipates after 8 or 9 days. Now, we also estimate the costs of these price pressures. How do we do this? We use a simple back-of-the-envelope calculation. We multiply the price impact from our empirical model times the average rebalancing trade when rebalancing happens. And we find that for the average calendar rebalancer, the analyzed costs amount to about 8 basis points. For the threshold rebalancer, is about 13 basis points. And to be conservative throughout the paper, we use 8 basis points as a benchmark estimate. And we wonder, is 8 basis points a big deal? We think it is. First, notice that this 8 basis points is substantially more than what funds pay to access to these markets in the first place, equity and bonds. Also, talking to pensions, they know that this is a concern, and they told us. Finally, we argue that as TDFs and balanced funds are expected to grow, this cost can even increase. We also translate this cost in dollar terms. It turns out it is about $16 billion per year, or $200 a year per US households. so focusing only in the US. And given the fact that the average pension contribution is about $400 a month, these $200 a year, about 4% of that, or 1 year lost of contribution over a 24-year horizon. Finally, we take the perspective of a real-time investor who wants to use the signals, these rebalancing signals, to trade. So, in other words, we take the perspective of a front runner. And we use our threshold and calendar signal to time the market. And it turns out that this strategy is well performing. Here, I report some of the results from this front-running trading strategy. In the first panel, we have some descriptive statistics. Notice that the performance of the strategy, which is the last row in panel A, is almost 10% a year with a volatility of 9%. And this generates a Sharpe ratio, a substantial Sharpe ratio larger than 1. In panel B and C, you can see two things. First, panel B shows that threshold and calendar signals are effectively timing the market, not loading on other sources of systematic risk. So we report the alphas of our strategy as benchmarked against the capital asset pricing model, the Carhart model, the Fama-French 5-factor model, and the Husch-Zhang factor model. And the alpha is highly significant. In panel C, we can see that this performance is particularly high during periods of high illiquidity and high volatility, when price impact is large, consistent with our interpretation. And you can see that also from this plot where we overlay the cumulative returns of the S&P 500 and our strategy. Notice that our strategy performs well during the whole period, is stronger during periods of high liquidity and high volatility. But if you, for example, take out of the performance the great financial crisis and the COVID pandemic, you will still find a Sharpe ratio of about 0.9. I'll leave it now to Cam to discuss some of the implications of our findings.
And thank you. The bottom line of our paper is that mechanical rebalancing induces predictability. And when you are literally advertising large trades to the market, certain investors will take advantage of that. It'll be profitable for them, but that money is literally being taken from the pensioners. The other thing is that the cost of trading are fairly well documented. And Ali mentioned that we can assume that their transactions costs for equity and fixed income are much smaller than the cost of rebalancing. But the difference is that the cost of rebalancing is not transparent to pensioners. It doesn't show up as the usual transaction costs. So I think it's important for our paper to document that these are real costs and these costs are substantial. Number three, and this is kind of in contrast to a lot of research in finance where you find an effect and then it goes away eventually. Well, there's reasons to believe that this effect has become stronger through time. So in very early data in 1960s and 70s and 80s, we don't see this because the size of the complex is small. Now it's large and growing. And as it grows, the potential for market impact increases. So this is not a fleeting problem. This is a problem that exists. And now I showed the graph of the profitability of the front running. It looks like there's no change through time. So this is not being fully arbitraged away. In the end, our paper is about documenting the effect. And the obvious question that we get is, well, this needs to be fixed. How do we do that? So our paper is not about proposing a solution, but it does seem obvious that there is at least a partial solution to this, and that is to make the rebalancing trades less predictable. So no pension should be doing 100% rebalance on the last day of the quarter. That makes no sense whatsoever. So that to have some randomization could be useful. This means changing rebalancing policies. Yes, it's difficult to do that through the investment committee. However, these costs are very substantial. I do want to emphasize that our estimate of the cost is very conservative, and $16 billion a year is a lot, especially if you consider kind of the present value of that loss through time. So I think that the next step in the research in this area is to design robust, systematic strategies that mitigate this unintended cost of rebalancing. And at that point, more than willing to take questions.
Thank you very much. It was really, really, really interesting. I will probably front run Michael in this case. And I will ask the question first. So firstly, I would like to tell you that I was working in a mutual and pension fund company, and you will probably guess what was the percentage when we had to rebalance our portfolio. And it was 2%. So, I mean, you are up. I mean, when I read your paper and I saw those 2%, I just remembered, yeah, exactly. We had a threshold of 2% and we had to rebalance back to strategic asset allocation when we, crossed the 2%. So until it was less than 2%, we were able to be unbalanced. But once we crossed the threshold, we had to rebalance. So you are right.
So there's many different variations of that. Mm-hmm. One popular variation is you cross the 2% and then you rebalance halfway.
Yeah, but you still rebalance.
You don't want to rebalance on noise. But again, this is a public rule. It's predictable. Exactly. You're going to be rebalancing. It's not all the way to exactly the target. There's predictability.
Yeah. And here is the question. We will probably all agree that it's inefficiency. So it's not efficient this way, and it's a market inefficiency. So here is the question. Why it is here? So, why there are not speculators that are able to step in and, move the markets back to the place and it's still there? I understand that it's probably a lot of the money. So, if all of the pension funds start to rebalance, there is not enough speculators to get this in line. So that's probably the answer. But, what is your point of view on that?
There's two answers to this, in my opinion. What you suggested is part of it. Mm-hmm. That the size of these rebalancings is just so gigantic that it kind of overwhelms the amount of active trading going on. And we all know that the share of active has gone down dramatically, where most people just doing like passive investing. The second point is more subtle. We say that these rebalancing rules are public, and they are. But I think that there's a select group of speculators that have actually figured this out. So it's not like every single hedge fund is trading this signal. And indeed, a number of hedge fund managers have expressed dismay at our paper because we're making public one of the signals that they use. So I think the combination of these things suggests that this effect persists. And not only does it persist, but as I said at the end, that the size of the rebalancing complex is growing, the amount of passive is growing, and it's not obvious that this effect will go away anytime soon.
Also, let me highlight that this front-running strategy is not risk-free. It is a risky strategy. And there is uncertainty about both the exact timing of the rebalancing and the magnitude, how much we are rebalancing. So it's definitely a risky strategy. And we know that there is remuneration on financial markets for bad risks.
It's risky with the Sharpe of 1.06.
Yes.
Yeah.
I think there's an added dimension that you're implying that, well, maybe you're not implying, I don't want to put words in your mouth, but the idea that the trades could be overwhelming in size and the risk, I think, plays into the idea that there's a big agency problem among institutional investors like pensions, where they're not really rewarded for outperforming very much. They are penalized for getting caught doing something against the grain. They could be trying to make an extra few basis points, end up losing a little more than that, and then getting in trouble with their board because it's hard to measure and communicate to their constituency. While there's also political pressures that may get them in the newspapers for doing something that other pensions aren't doing, all in the effort to benefit the beneficiaries, but yet blowing up against them. And unlike hedge funds that understand the risk and are motivated to make alpha, the pensions might be motivated by a different dynamic.
Yeah, I totally agree with that. And indeed, the agency problem is exactly what we heard in our roundtable. So this is not speculation. This is the real thing. And you can imagine that a new rebalancing rule is proposed, and initially it actually loses relative to the old rule. And the people that are proposing the change are not rewarded for that. That just induces risk and inertia. So it's better to just keep it the same. And I think part of the role of our paper is to bring this discussion into the public sphere so that there will be pressure. So whether the pressure comes from the media or the government, because these sovereigns obviously report to government, that when they see the extent of the loss, and we worked hard to try to translate this to the average pensioner, what is the cost? Then perhaps there will be some action that is mandated to fix this problem, which we, as I said, consider economically significant. So, Michael, I totally agree with you.
I think your example of the alpha signal on the alpha desk is probably the most likely model, where a custodian or a consultant will perform this task on behalf of the pension for a fee and maybe take some of the risk in return for a fee. And that way the pension doesn't have to worry about communicating that to their constituents, and yet they get the benefit for it.
Yeah, it's such a backwards model. There's a problem that the pension has because of mechanical rule. So instead of fixing the problem, what they do is to allocate to somebody that trades, that front runs effectively what people are doing and produces some sort of profit for that. It just seems backwards to me. And also think about the size of the allocation that would have to go to this particular strategy to fix the 8 basis points. So my impression is that maybe that alpha desk could, from that particular strategy, add a basis point to reduce the cost for the pension from 8 basis points to 7 or maybe 6. And that's just not good enough. So again, it just seems more logical to fix the problem rather than putting a Band-Aid on it. And that is going to be difficult given the agency problem that you mentioned, but it's something that should be done.
There are some organizations that can, for instance, use dark pools and crossing trades that actually have an advantage with lower commissions or no commissions, right? That can make a profit and offer the service, and everybody could make money. Is that possible?
Yeah, so we thought about this a lot. So, and indeed, this idea of kind of random rebalancing, you would think might apply to, let's say, index rebalancing. And it doesn't really work for index rebalancing because some predictability actually allows the liquidity providers to be ready to offer the liquidity. And notice that these trades, as I emphasized, are not information trades. These are trades that you would think would be kind of valuable. It's like, Robinhood selling, its orders, a payment for order flow. Those are ideal orders because they're retail orders, and retail investors don't have access to the sort of information that hedge funds actually have. So it's kind of the same thing, that these pensions are trading just to a target. They don't have any special information. But the difference here is that for the index rebalancing, the liquidity provider's more than willing to get these trades, given that they're not information trades. And it should be predictable for them to organize this. But what we're detailing is something different. We're not talking about individual securities. We're talking about the market as a whole. And that predictability, and given the size of this complex, suggests that the random method has got some merit for the market as a whole. And the solution, again, is not so obvious given the size of this complex. It is just so large that it overwhelms whatever alternative liquidity pools are available, whether a dark pool or something like that.
Cool. Thank you. Thank you very much. Thank you, Alessandro. Thank you, Campbell. It was really great. Your paper deserved to win our competition. It was really, 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 really great. From the point of allocator or asset allocator or pensioner, also from the point of somebody who is speculator or trader, because we'll learn something new and we can trade it until it's closed. Everybody who is saving the money in a pension, I hope that they will be closed in the future. So I will be very, very interested to see how it will look like in 5 years. If the effect is still present, or there are the steps that will be taken in the future that will close the gap. So we will see in the future, in the next 5 years, or 5 in 10 years. I'm really, really interested to see, if it's still present. So we will see, maybe in the 5 years, we will have this discussion and we will just say that, nothing changed.
Thank you, Rado. It was a pleasure. Thank you, Michael.
Thank you, both of you.
Thanks. Thank you for discussion.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.